When you think about investing and choosing an appropriate investment, one of the most important concepts to understand is investment risk. In its most basic form, risk is uncertainty. And a common way of judging the total risk in an investment is to look at the variability of its returns over a particular time period. The general rule of thumb is this: the more return you hope to get from an investment, the greater the amount of risk you must take on. Sorry, no shortcuts here. The sad truth with investing is that you cannot expect to get a return without taking some amount of risk. There are many types of risk as well as ways to quantify that risk. But let's start with the most common way an investment's risk is measured: standard deviation. To understand standard deviation, imagine a table with a big bullseye on it. Now imagine standing over the table, taking 100 gummy bears in your hand and dropping them, one at a time, directly over the centermost point of the bullseye. When you finish dropping all the gummy bears on the table, draw a circle around the first 68 gummy bears closest to the center of the bullseye. The radius of that circle would be called one standard deviation, or a standard deviation. It tells you how accurate or variable your attempts to hit the center of the bullseye have been 68 out of 100 tries, or 68% of the time. And this concept holds true with an investment's risk when you're looking at its standard deviation. So if we imagine that an investment achieved a return over the last year of 10%, and it has a standard deviation of 5%, it means that 68% of the time over the past year, the investment produced returns within the range of 10% plus or minus 5% in either direction. So as little as 5%, or 10 minus 5%, and as much as 15%, or 10 plus 5%. To picture the variability of returns on a riskier investment, think about our gummy bear example and now use M&Ms instead. What you'll find is that the radius of a circle drawn around the first 68 M&Ms will probably be bigger than the gummy bears. M&Ms bounce around a lot more than gummy bears, don't they? This can help us understand how a riskier investment has more uncertainty and variability in what return it might get for you. So to recap, risk is a really important thing to think about when you're investing. And a common way to understand an investment's risk is to look at its standard deviation, which tells you the range of possible returns most of the time, or 68% of the time, during a given time period. This should then make you think of bullseyes, gummy bears, and M&Ms. Until next time.